let me start by addressing a very simple, basic question, which is, what is a multi-asset fund? Some of you may be familiar with the concept, others might not. And the clue is in the name. It's a portfolio made up of a variety of different asset classes, each of which has a particular role in the portfolio, and from one type of asset to another, quite different risk and return characteristics. And a good way of kind of introducing you to the area is to encourage you to think about assets in three different categories or three different blocks. There's a group of assets that we can all invest in that I would categorize as growth assets. Equities is the best known of growth assets. A second block of assets is diversifying assets. These are assets that have returns that are typically a bit lower than equity, but also a bit less risk than equities. And they behave in a way that is, in some instances, similar, but not exactly the same as the equity asset class. So they diversify the portfolio. They introduce something new to the portfolio. And then the third group of assets I've described here as hedging assets. These are quite different from the first two groups. These are assets that perform well when bad things are happening in the world. You could think of them as being the ballast in a portfolio. They kick in when things aren't going as well in the world, and typically growth assets and diversifying assets are doing less well. So I'm going to explore these different asset types in more detail in a moment, but before I do that, let me talk about one or two of the key principles that underlie multi-asset portfolios. The first, and this is probably the bedrock of multi-asset investing, the first principle is that it is unwise to put all your eggs in the same basket. Now, I'm pretty confident that a lot of the people in this room, maybe most or even all the people in this room, are familiar with that idea. But when I look at the broad investing audience, I don't think that that's the case. In actual fact, there's a strong tendency for people to put all their eggs into one basket. And the asset that attracts more flows than anything else in a big sense is housing. People love investing in housing. And I think it's kind of understandable given the experience we've had in the UK. But what we've enjoyed over the last 20 years is by no means a universal phenomena. And this chart here is looking at residential property in two other countries, United States and Ireland. And as you can see, between 2000 and 2008, that investment worked extremely well for people in US and Ireland. Unfortunately, as you might remember, it's beginning to dim into the distant past, things didn't work out quite as well over the next few years. And people who are exposed only to the property asset had a very difficult time that it's only recently they've fully recovered from. So the idea of investing everything in the same asset class, I would contend, is quite dangerous. What else can we do? I'll start by introducing a very simple multi-asset structure and look at how that structure performs in different economic and market environments. This chart is going to explore the last 20 years, so it's looking back over a considerable period of time. And the portfolio that I'm looking at is as simple as you can imagine. 60% invested in equities, 40% invested in bonds. Some of you may remember the first couple of years of the noughties were very difficult for financial markets. We had a very severe, a 60-40 portfolio made up of equities and bonds, delivers a stability to investment returns that is really welcome, particularly in the type of circumstances that we had at the beginning of this century, when you can see the light blue line there is equities. We had a profound bear market in equities. People lost half their money. However, if the same people had 40% of their portfolio invested in bonds, the return that they received is picked up by the middle line in that chart. Over a period where equities did extremely badly, people made a modest return Now, for many people, that's a very welcome development when they fear that things are going to look a lot worse. If we move on to the next time period, we see the same pattern, but this time the world is in a much better place. The equity return is very good. Bonds actually deliver a decent rate of return as well, and the combination of the two, again, delivers a rate of return that is really quite welcome, 10% per annum or thereabouts, and a volatility that's much, much lower than the same investor would have received had they just been invested in the equity asset class. Now let's move a bit more up to date. This is the global financial crisis, the most difficult circumstances that I've seen in financial markets in my career. The light blue line in this instance shows equities falling more than 50% at the very worst. Bonds, once again, delivered a positive rate of return, and that combination of the two meant that even through the worst financial crisis since the 1920s, investors in this instance lost only a modest amount of capital. Again, a very welcome outcome in a difficult period. And then the last 10 years, just to complete the picture, the last 10 years, equities have done very well indeed. Fixed income, actually returns have been very modest in fixed income by historic standards, and that explains why the middle line is closer to fixed income than equities in this instance. And the reason for that is the very low interest rate environment that we have around the world. Fixed income, inevitably, when rates are zero or close to zero, is going to deliver a much, much lower rate of return than we've enjoyed in previous periods. But the message is still the same. We get a rate of return that is attractive, and we get a volatility pattern that is definitely better than the equity market. You can see meaningful sell-offs in 2011, 2015, 16 that didn't really feed through to the multi-asset investor in a painful way. If we move on another slide, why is this so, I think, is an interesting question to ask. And the answer is that different assets in financial markets behave in very different ways given a certain climate or a certain set of circumstances. And a good way of understanding this is to consider a world where the circumstances that we face is the weather. There's only one pattern of weather, and in this world, you've got a choice. You can invest in one of two businesses. You can be an ice cream seller, or you can be in the umbrella business. And as you'd imagine, selling ice cream is great in the summer and doesn't really generate much income in winter, and vice versa. Now, anyone faced with that choice will work out quite quickly that actually what you don't want to do is invest in just ice cream or just umbrellas. Because if you have 2 or 3 years in a row where the summer is bad, you have got very, very little income. Quite quickly, you find that you're under considerable financial pressure, and vice versa. Now, the lovely thing about this is if we imagine that in the long run, these two businesses generate the same income on average over time, then by having an investment in both these industries, we lose all that volatility and we get the same return, the same income as you would if you invested one or t'other. That is at the heart of multi-asset investing. If we move on another slide, the world we live in is more complicated than I've suggested thus far. There's quite a variety of different investments one can include in these portfolios. And let me talk a little bit about the key characteristics of each of them. The first, and I've talked about this already, is equities. Equities are growth assets where the critical aspect of them is that shareholders get the returns from a business when every other bill has been settled. You get the residual, if you like. And people often think that equities give you exposure to economic growth, and they do. But actually, what they really give you exposure to is profits and profit growth. And profits are far, far more volatile than the economy is. So when things are going well, equity investors do extremely well, and vice versa. And that's the problem that I alluded to when I was talking about the last 20 years of investing. If we move on to bonds, going back to that framework that I introduced at the beginning, bonds are the perfect best hedging asset that one can invest in. Why? Because these are assets that have quite different characteristics from equity. The rate of return that you're going to receive is known from day one. So there's no variability, there's no uncertainty. And what makes them very interesting and very useful in a portfolio context is that when bad things happen in the world, interest rates typically fall, and that increases the value of bonds. So if you've got a piece of paper that guarantees to pay 5% per annum for the next 10 years, and interest rates fall from 5 to 1, the value of that piece of paper improves dramatically. And that environment typically happens when equities are doing badly. So bonds are a perfect complement to fixed income. But that's not the whole picture by any means. We move on again. Credit is the first hybrid asset that is worth a mention. Credit shares some of the characteristics of equity and some of the characteristics of government bonds. Why is that so? Because you're investing in companies this time rather than lending to governments. You get a small premium for investing with high quality companies rather than governments. So there is some sensitivity to the performance of the business. But the character that I described for bonds, a tendency for the value of investment grade bonds to go up when bad things are happening in the world, that's also a characteristic that we get access to with that asset class. And then quickly to finish, property is another hybrid asset. A lot of people think of property as being similar to equities. It is in the sense that the payment stream is not guaranteed, but there's a high level of predictability about it. And the very, very interesting characteristic about property is that it quite likes an inflationary environment. So if and when inflation picks up on a sustained basis, property gives you a hedge against that development. And those first three investments typically don't do that nearly as well. Commodities is the next one. And commodities, in some senses, are property on steroids. They don't perform very well most of the time, but if and when we get inflation, commodities can really come into their own and mitigate losses that might apply to certainly the first three asset classes and maybe even the fourth. So there's something quite unique about commodities that makes it an interesting asset to own. And then finally, alternatives. Alternatives are man-made assets. They come out of the investment community and they give you exposure to a very wide variety of different themes, some of which aren't connected to the economic cycle at all, and that makes them quite interesting. One asset that falls into that category is insurance. One can write insurance exposure and get a return from that, and returns to insurance are quite different from returns to those other asset classes, and that makes them interesting in a portfolio context. If we move on again, that's not all we need to know to do this job well. And to pick up on the climate change, the climate theme again, one of the things that we need to have some insight into is not the climate in a weather sense, but the climate in an economic sense. And one of the important things for someone like me is determining whether we're in spring, summer, autumn, or winter. And if I can narrow it down a bit more carefully, the most interesting and most exciting times in financial markets are where you come out of winter into spring. That's typically where returns are at their very best. And the most damaging phase of this cycle is when autumn turns to winter. And we need to be very alert to where we are in that cycle and what might be likely to happen to the climate next. And I'll talk a bit about how we do that in a moment. If we move on again, these are some of the tools that we use to understand where we are in the economic and market cycle. As you can see, there's a wide variety of different inputs that one needs to be on top of. I've grouped them into three categories. Variables that tell us something about policy. What I mean by policy is what central banks are doing with interest rates, what central banks are doing with money printing. And that has been a tremendously important influence on market returns for as long as markets have existed. But in the last 10 years, it's been particularly important. There's been no more important influence than behavior of central banks. And I'll talk a little bit about what's been happening recently, just to bring that concept to life. The second set of variables concern the cycle, looking at the ebb and flow of economic activity. Again, there's a wide range of different inputs that can tell us something about what's happening to our own economy, what's happening to the global economy, where things are speeding up, where they're slowing down. And then the third thing that one needs to have a view on is what everyone else is doing and how everyone else's portfolio is positioned. Because one can be correct about the first and second thing, but if everyone understands that and has already got a portfolio that reflects the market's view on policy and on the cycle, then that information can become actually worthless, or even worse than that, can take you in exactly the opposite direction. So to make that point more lucidly, at the end of last year, policy, particularly in the United States, was quite tight. Interest rates were going up. The expectation was they'd go up again in 2020. The economic cycle, certainly outside the United States, had slowed a lot. And even in the United States, there were some signs that things were going to be a bit worse in 2019. And all of that became wildly discounted in asset prices by the time we got to Christmas last year. That was critically important to understand that positioning and sentiment, positioning had gotten very negative, sentiment had gotten very negative. There are moments in time where it's so bad, it's good. And that was one of those moments in time. And it was only by understanding what other investors were thinking and doing that one could really get an insight into that. If we move on again, the three elements of building multi-asset portfolios involve what I've just described: understanding the world at large, how it relates to behavior in financial markets, and then identifying what you actually want to buy to take full advantage of that. And I work with a team of people, 10 individuals, who spend their lives scouring the opportunity set of investments that we face in those 5 categories that I described earlier, identifying managers who make investment decisions in a way that is insightful, that is sensible, that is going to give us the best risk-return outcome in each of the asset classes. So there's a whole raft of work away from what I described a moment ago in understanding the world, which is about understanding the opportunity set. Move on again, please. A third thing that we need to be alert to is price. One of the realities of the decision set that we face is that there is an extraordinary range of different prices for investment products out there. This happens to be looking at the price of platforms. And we've got a list of providers and then a list of portfolio sizes. As you can see, different providers price platforms at very different levels. And it's no different when you turn to individual investments. You can pay a lot of money or a very competitive fee to get access to UK equities, for example. So we need to be alert to that. If we move on again, we're almost done in terms of the inputs to building these portfolios, but we're not quite done. The final thing that you need to know about is yourself, because portfolios need to be tailored to people's individual circumstances. And this is a simplification, but I think it's a useful way of thinking about this particular problem. We need, or you need to know something about where you are in life. I think age is very important when it comes to building portfolios. If you're young, you can afford to take risk. If you're old, less so, particularly if your income is derived entirely from the assets that you own. In those circumstances, you can't really afford to lose money in a significant way like people did in 2001, 2002, and in 2007, 2008. You need a different sort of portfolio to avoid that outcome. And then the final thing that one needs a bit of insight into is your own attitude to risk. How do you feel about losing money versus making money? Some people can't tolerate the notion of waking up in the morning and finding that they've lost money over the last week. Other people have got no problem with that at all. So you need to know something about yourself. If we move on again, who's best placed to do these different things? I've put this together to consider the individual versus the professional builder of multi-asset portfolios, someone like myself. In terms of knowing yourself and your goals, I can't contend that anyone knows that better than you do. So I think the individual certainly has got a head start on the professional in this area. Ability to identify a good manager, I think that the team of people I described a moment ago do that job exceptionally well, and it demands a lot of time and energy. In comparison, I think it's more difficult for the individual investor to really know the opportunity set as well as they might. Evaluating portfolio risk, I'm describing a world that's got some complexity to it, and I think for the individual investor to be able to understand and map the nuances of these different investments onto the economic and market cycle is difficult. And then in terms of understanding the linkages between macro and markets themselves, again, I think that's a very difficult thing for the individual investor to do, and something that people like myself are better placed in. If we move on again, let's talk a little bit about what's actually going on in the world and what that means for portfolios today. If we go to the first slide, this slide is looking at what I consider to be the 5 most important variables when considering the market and macro environment that we're in. If there are 5 things to keep a careful eye on, this is them. The first is the global growth environment. When expansion becomes recession, bad things happen to risk assets. It really is as simple as that. So we need to know what's happening in the global growth picture. And here, we've been through a period where something really quite interesting has unfolded. The chart shows growth in the US and growth outside the US. And for the last 18 months, US growth has been significantly better than growth in the rest of the world. And that's had some quite significant impacts on financial markets. First of all, investments outside the US have performed less well. That's perhaps not so surprising. But on top of that, it's had a meaningful impact on the next variable, which is global interest rates. And to understand why the US is so central to global interest rates, what you need to appreciate is that the Federal Reserve doesn't just set monetary policy for the US, it sets monetary policy for the world. And when in 2018, the US was growing faster than everyone else, interest rates in the US continued to rise, and that meant that interest rates for everyone were continuing to rise, despite the fact that other economies were slowing. That created some problems that really became very obvious by the tail end of last year. What's the good news is that in the first quarter of this year, the Federal Reserve has changed its policy, and market-based interest rates have come down quite a long way. So there's been an improvement in terms of the interest rate environment. A third variable that we need to be sensitive to is the oil price. And this was the first thing that changed to give one some comfort that maybe the system would actually stabilize by the time we came into this year. Because in the fourth quarter of last year, the oil price came down a long way. And a lower oil price is really good for consumer spending in countries that aren't big producers and exporters of oil. That's basically most parts of the world. To bring that right up to date, the oil price has recovered a bit this year, and whilst I feel very happy that interest rates have moved down, a bit less happy that the oil price has moved up. The dollar, one of the things that I think often surprises and confuses people is the importance of the dollar to the global markets. And the best and most powerful way that I can explain the importance of the dollar to you is this. Imagine a world where everyone borrowed in US dollars to fund their mortgage. That'd be an interesting world, because it would mean that if your currency fell relative to the US dollar, now let's say for argument's sake the pound halves relative to the US dollar, that means that the value of your mortgage has doubled. Instead of having a a $100,000 mortgage, you've now got a $200,000 mortgage. That's a very, very frightening experience. And so the level of the dollar matters a lot in the world, and particularly in emerging markets. Now, one of the things that I thought might happen this year, but hasn't really happened so far, is that I thought the dollar might come down in price. And the reason I thought that would happen is because I thought that global growth, and particularly US growth, would slow meaningfully, and that would depress the dollar. That would be another welcome development. So far, we haven't seen it. And then the final thing that one needs to be alert to is volatility. Financial market volatility really matters in terms of investor sentiment and investor positioning. You can see at the tail end of last year, volatility was incredibly high, and that fed into the pricing of different assets. If we brought that right up to date, volatility's collapsed in part thanks to the Federal Reserve and their change of stance on monetary policy. That's quite welcome too. So in terms of what's been unfolding this year, I would contend that quite a lot has happened that has encouraged me and others to think that the world looks better. Now, there's a sting in the tail. I said that at the tail end of last year, it was so bad, it was good. I would now argue that where we stand right now, a lot of that bad news has been priced out. Prices are up to speed with the developments that I've just been talking about. And so whilst in December last year, in the very early January this year, I was buying risk assets, actually in the last few weeks, I've been going in the opposite direction and taking some risk off the table because the world has improved, and most importantly, markets have repriced to reflect that improvement. If we move on again, I've talked a little bit about the US, I've talked a little bit about China. Let me just mention very briefly corporate behavior. We do need to be alert to what the companies around the world are doing. And in particular, one of the things that still troubles me about the world we're in today is that if you look at the surveys of chief executive and chief financial officer opinion and their optimism about the world we live in, as you can see in the chart, it took a significant turn down at the tail end of last year. And this is one of the things that hasn't recovered. So as we go through April and May, I do think we need to be alert to the possibility that whilst financial market conditions are better, the corporate sector is still behaving in a way that's a bit more cautious. And if that's right, I think selling some risk at the end of the first quarter might turn out to be an appropriate thing to have done. I'm going to have to flash through these last couple of slides, I'm afraid. If we move on again, politics, this rogues gallery of politicians. I think if there's one point I make here, one of the things that's changed in my career, and this is important, is that we lived for a long time where politicians thought the most important thing by miles was the state of the economy, and everything else was subservient to the state of the economy. That is no longer the case. And there's some other considerations that means that politics matters more. And if we move on one more time, this is the range of funds that I manage. They have different risk characteristics, and this goes back to the fact that clients come in different shapes and sizes. There are some portfolios that are at the lower risk end of the spectrum for people who are perhaps older in life, who need to be more certain of the security of their assets and the security of their income. And then at the far end of the range, we have portfolios that are actually built typically for younger people who can take more risk, who don't worry so much about near-term volatility in financial markets. And if we look at the final slide, all those nuances I was describing in terms of knowing the opportunity set, knowing the world and how it feeds into financial markets, those insights can be captured in performance that's better than average. And that's really the essence of what I do. We're trying to package all that insight together to deliver performance. These are relative performance numbers that's better than average. Thanks very much, and I apologize for the technical problems.